Welcome to this week's episode of Your Stock Request for the 26th of August. Hi, I'm Michael Gable, Managing Director at Fairmont Equities. Your Stock Request is the weekly video where I take your requests and analyse the share price charts. So this week we have Coles, Renascor Resources, Harvest Tech, Pact Group and G8 Education. So if you have a request, send it through. Make sure you've signed up to the free newsletter. But if you like our best ideas, you need to be getting the Dynamic Investor Report, which comes out every Tuesday. But if you do enjoy these videos, we'd love you to share them on social media or even leave us a review. Our main business, of course, is on the broking side. So if you'd like to open a broking account with me and have me call you when I've got an idea to buy or sell, then please let me know. And any advice here, of course, is general only. So we've got the 1 year chart here of Coles. Since that low in sort of February, March, the trend was looking pretty good. So, nice impulsive moves up, small corrections, another consolidation here and then another break and a very steady uptrend. Clearly a beneficiary of the lockdowns, so it was never going to last forever. And as we could see, as it's come up here towards the old high, it's found some resistance. So ideally, as a stock comes up near an old high, you'd like to see it just consolidate sideways and absorb the selling pressure. But in this case, we could see it was sold off quite sharply. So what that means is as investors start to hit the sell button, there's been a lack of buyers to support the stock. So we could see a massive move down here. And then again yesterday, gapping down and closing near the lows, decent volume as well. So look, we might get a bit of a sort of dead cat bounce here where it makes a little bit of a feeble rally for a few days. But to me, this looks like we've seen a top now in the share price of Coles. Okay, Renascor. So we've been seeing a few of these, few similar looking charts to this recently. So a lot of these smaller stocks, late last year or early this year, had massive rallies on good volume and then have eased back over the course of about 6 months, and now they're starting to move again. So basically spike, volume, flat consolidation, less volume. Now the buy signal was here in August, so we had this sort of rounding out and then it sort of popped up above this level here on good volume. Actually, this is one we had in the Dynamic Investor Report a few weeks ago, just noting the buy signal here. As I said, there's a number of charts that look fairly similar to this. So we had the move up finally in sort of early August on volume. The pullback here a week or two ago, low volume, retest the sort of breakout zone. And then in the last few days, as we could see, it's marching on with the volume coming in. So just just a classic looking chart there. Nothing wrong with this, and I think this will just continue to rally strongly from here. Okay, Harvest Tech. So as we could see, if we go back a bit, like with a lot of stocks, nice rally off the lows last year. So this one peaked at the start of the year, and then it's made these lower highs and lower lows. So, uptrend was, as we could see, was pretty much over here on the spike down and the failure to rally. So it is now trending back lower again. I mean, it's pretty much mirroring what we had here. So as it sort of built up, spiked, came back, and now there's like a mirror image on this side now of, in terms of the downtrend compared to the uptrend that was there. I think the risk is to the downside. The other thing I've noticed is it looks like we've got this sort of big potential head and shoulders. So we've got this left shoulder, the head, sort of right shoulder, probably a bit clearer if we look on the weekly chart. So that could be a top. So what we need to do is just keep an eye on this neckline, of course. If it bounces and rallies from here and takes out the prior high, that's a start of an uptrend. But, just keep an eye on this neckline, because if it breaks that, then it may well come all the way back down here. All right, Pact Group. So nice run off the off the March lows last year. Most recently we looked like it was struggling here, but then it broke up to a new high for the year, did a bit of a retest, and then marched higher. So all of that was looking positive, good volume on the way up, all very good. However, we do have a sharp reversal here, which is a concern. So, we've got this, especially if we look at the last week, we've got this run up here for a couple of days, a doji, evening star formation, whatever you want to call it, and then a couple of heavy down days. And look at the volume here on this down day. So not what you want to see. You really, again, if you want to be bullish, this needs to be a bit flatter on lower volume, not sharp move down on big volume. So this formation here is often the sign of a top. It's a reversal pattern. I think if you want to be a bit more confident that it's going to fall, I guess we can look at support near $4 or even $3.80 for confirmation. If we get a break under here, then clearly this big run that we've seen in PGH would be over. Okay, G8, I think it's worth starting with a weekly chart on this one and zooming out just to get the big picture. And the big picture is it's been a massive capital destroyer over time, big downtrend, and that downtrend over the last several years is yet to be broken. So if we move back to the daily, we could see here it's tried to rally. I think in terms of what we've seen in the last several weeks, with this rally here, you could look back and see that there was a lot of resistance around 105. I would have preferred to, if I was buying this, I'd want to at least, as a short-term thing, see 105 get broken, but we could see it rallied up to 105 and then got sold down. So it's failed there, and I just think the most likely direction for this is still to the downside. All right, well, that's all for this week. If you have a request, send it through. I'll try to cover it next week for you.